Short selling. It's a Wall Street term that can make even the most seasoned investor sweat. Imagine this. You're betting against a stock, hoping it goes down instead of up. Short selling is not for the faint of heart. It's a high-risk, high-reward game, and it's not one you want to play without understanding the rules. In essence, short selling is borrowing shares of a stock you believe is overvalued and selling them at the current market price. Your hope is that the price will go down, and you can buy the shares back at a lower price to return to the lender, pocketing the difference as profit. Unlike traditional investing, where your losses are limited to your initial investment, short selling opens you up to potentially unlimited losses. So why do people short sell if it's so risky? The answer lies in the potential for significant returns. Here's the cold, hard truth about short selling. The most you can ever make is 100%. That's if the stock you shorted goes all the way down to zero. But the downside? Well, that's theoretically unlimited. Imagine you short sell a stock at $100 per share. The absolute best case scenario is the company goes bankrupt, the stock price plummets to zero, and you get to keep the entire $100 per share. But what if the company announces a groundbreaking new product, and the stock price soars to $300 per share? You're now on the hook to buy back those shares at a $200 loss per share. This asymmetry in risk is what makes short selling so dangerous for inexperienced investors. It's like playing Russian roulette with your portfolio. You also have to factor in the costs associated with borrowing the shares, such as borrowing fees and interest. These costs can eat into your profits and amplify your losses if the trade goes against you. Remember the housing bubble of the mid-2000s? Investors were snapping up mortgage-backed securities like hotcakes, convinced that housing prices would rise forever. But a few savvy investors like Michael Burry saw the writing on the wall. Burry, a hedge fund manager with a knack for spotting bubbles, decided to short the housing market by buying credit default swaps, essentially insurance policies against mortgage defaults. It was a bold move, one that initially drew skepticism and ridicule from his investors. As the subprime mortgage crisis unfolded, Burry's bet began to pay off. Housing prices plummeted, defaults skyrocketed, and those credit default swaps he bought became worth a fortune. Burry's fund, Scion Capital, made a killing, returning 489% to investors between 2005 and 2008. But Burry's story, immortalized in the book and movie The Big Short, is an exception, not the rule. Section 4, The Short Squeeze, How Reddit Traders Turned the Tables. In early 2021, the financial world watched in astonishment as a group of retail investors on Reddit, primarily from the Wall Street Bets subreddit, took on some of Wall Street's biggest hedge funds and won. Their weapon of choice? A good old-fashioned short squeeze. The target was GameStop, a struggling video game retailer that had become a favorite target of short sellers. Hedge funds had bet heavily against the company, convinced its brick-and-mortar business model was outdated in the age of digital downloads. The Reddit traders, noticing the high short interest in GameStop, decided to orchestrate a short squeeze. The GameStop short squeeze became a global phenomenon, captivating the attention of mainstream media and highlighting the growing influence of retail investors in the market. Section 5. The hidden costs of short selling fees and interest can bite. Short selling might seem straightforward at first glance, but lurking beneath are fees and interest charges that can swiftly erode your profits, or worse, magnify your losses. The primary cost is the borrowing fee, which is essentially the rent you pay to the broker for borrowing the shares. This fee is typically calculated as a percentage of the value of the shares you're borrowing and is charged daily. The more in demand the stock is among short sellers, the higher the borrowing fee. Additionally, you'll likely incur interest on the margin loan used to finance the trade. These hidden costs might seem minor, especially if you're expecting a quick profit. But over time, they can accumulate, particularly if the trade doesn't go as planned. Imagine shorting a stock with a high borrowing fee, and then watching the price move against you. As we've seen, short selling is a complex and risky strategy that can lead to significant losses if not executed properly. It's crucial to understand the mechanics, risks, and costs involved before diving in. If you're considering short selling, make sure to do thorough research and consider consulting with a financial advisor. Remember, the stock market is unpredictable, and even the most well-thought-out strategies can go awry. Stay informed, stay cautious, and always be prepared for the unexpected. Thank you for watching. If you found this video helpful, please like, subscribe, and share this video for more insightful content on trading and investing. Happy trading!